Many bullshit strategies out there, right? But here things are different. We are going to use a multi-time frame, multi-concept strategy in a stock charts and forward test that so you can see the results. We are going to use market structure as our trend identifier, Fibos as our zone accuracy tools, and divergences in lower time frames as our entry setups. Watch the video until the end so you learn the strategy and you learn how to manage your risk with this strategy, and just go and test yourself. It will change your life. Divergences are an old concept in trading, like a billion years old, and they are powerful too. But who makes money from them, right? It's because they don't know how to identify the context which their setup is forming it. It's the most important thing in trading. You should know the context of your market that you are trading in, and you should know the direction that you should take trades. I mean, should you take selling setups or buying setups? Besides that, they use the wrong tools and they are single concept, single time frame lazy traders. But in this video, we are going to use it right in right context and with the right tools to help you make profits from divergences. I'm Mehran, your trading companion, and thank you for watching. Now we are going to talk about divergences, market structure, and Fibonacci's. So what is a divergence? What does that even mean? In simple terms, a divergence is when two parts of one system don't do their jobs together. For example, one tire of a car is spinning clockwise and one of the tire is spinning opposite of that one. It is a divergence. In the markets, a divergence is when two parts of a single market don't move together in sync. For example, the price is going up but momentum is going down, or the price is going up and the volume is going down, or a high correlated asset is going down but the price of the other correlated asset is going up. So when two parts of a single market are not in sync together, it's a divergence. Like buying pressure is going down and price is going up. And why is that important? Because it is a sign of weakness with indicators. I mean, for example, RSI or MACD. Or it's a sign of somebody big being wrong big time, like in high correlated assets. For example, buyer or the seller is wrong with their positions. And why we pay attention to divergences? Because it increases the probability of a reversal or a continuation. So now let's talk about market structure. Using divergences without confluences is the reason of death of too many trading journeys. Always when using a setup, especially an entry setup, we should pay attention to first context of the market and second the zones that we are interested in investing in. So we use market structure concept as order flow indicator, or we use it to identify the direction of current market movement. Let's talk about this on charts. So now we should use our structure and break off structures for identifying the order flow and direction of the market. What is the order flow? The order flow is the direction which the market is moving. It goes down, it comes up, fills more order, it goes down, it comes up, fills more order, it goes down, it comes out, fills more order, and it continues its movement. The most important problem that all the traders have is that they are just searching for Holy Grail. In Persian, we have an expression, a funny one. We say that they are searching for armpit of a snake. There is no such thing. And they want to search for a three candle formation that is going to provide them with a lot of profits, and that doesn't happen because the market is not mechanical. The market is made of millions of traders out there, millions of institutional traders, and more than 250 million retail traders out there. So you can't find, for example, a pattern or a candlestick pattern that works and makes you profit, because the market is dynamic. It is like a beast which is made of millions of people as it sells. So we can't just use our setups to profit from the market. Why? Because we should ensure that we are in the current direction and in the right direction of the market, and we use the highest probability zones to use our trading setups and trading entry setups there. So now let's talk about the market structure. You can see the ultimate smart money concept video and the ultimate liquidity videos and the free smart money course in the channel. They are separate playlists that you can watch them. In the free smart money course, we talked about structures a lot, so you can watch that for learning how the structure works in details. But here we are going to cover it briefly. So when the market starts and we open our charts, we should pay attention to primary structure. Primary structure of the market is the structure that has an obvious high and an obvious low. So it is our primary structure. For example, it came up, it came down, and the market is here. Which is our primary structure? It is here, and the broken structure is here. If we have our primary structure and we don't know which structure got broken in the past, for example, we open our chart and it's the beginning of the chart. For example, it's, I don't know, a coin of cryptocurrency that is going public, or it is a stock market that is going public. So when we are in that situation, we only have our primary structure. That's the low of that chart, or the obvious low and the obvious high. What to do now? It's our primary structure. We wait until the high or the low gets broken. And that's our primary direction. We should take selling or buying setups only in that direction. Let's imagine the market break its high. What we do? We have this low that broke this high, and this is our important leg, our primary leg, that we are going to pay attention to take trades only in the direction of this leg. What I mean is that we wait until it corrects itself or pullbacks, and then after this retracement, for example, we find our POI using Fibonacci tool that I'm going to cover after the market structure to enter the market. How we enter the market, how we identify our stop loss and take profits using divergences. So when the market comes up, break this high that we name break of structure or BOS, break it here. We wait until it retraces and we try to take trades on the right POI using Fibonacci and liquidity and order blocks with the help of our entry setup that is going to be divergences plus shifts to enter the market. Don't confuse yourselves. The only thing that we are going to learn here is that we use market structure and break of market structure for identify the direction of the market. So the high gets broken, so we wait for this retracement to enter the market for buying opportunities. And when, for example, it comes down and it breaks the low, we have our high here, we have our low here. When the market starts to retrace, we use our Fibonacci tool to find our right POI. For example, we have a POI here, and we use divergences plus shifts to enter the market here that I'm going to cover in the rest of the video. So let's see that on charts for more details. I'm going to use indexes for this video because they are highly correlated with the stock market, so you can use indexes or you can use the stock market stocks itself you should first learn the strategy, then you practice that strategy until you get mastered in it, and then you are going to test that strategy in the stocks or the pairs or the assets you like to trade with. So first test them. For example, this strategy may not work in gold. For example, I don't know, I use liquidity points and order blocks more in golds, and I use these kinds of strategy in indexes and stocks. So you should first pay attention to the asset you are going to trade and test these strategies there first before using them in your journals or for practicing or for building yourself as a trader on those strategies. So test these strategies first. But how to identify and use the market structure? Let's go back, for example, here. Now, the market has broke its high. We have a break-off structure here. I'm going to mark that as a BOS. So we have this primary leg or major leg. It starts to come back. Then after this, we use our Fibonacci tools and our concepts to find the right trade. And now we wait until the high or the low gets broken again. You can see that the high is getting broken, but I use candle bodies to validate my structures. So the high got broken, and now we have this leg as our primary leg. Now we wait until it retraces, and we use our Fibonacci tool and our entry method to enter the market for only buys. We don't sell in a strong uptrend. It is a very strong uptrend right now. When the pullback starts, we use our Fibonacci's and tools to enter the market for buy setups. You can see that it works well. After that, it is our primary structure from here to this low, because it is our strong low. The low that broke the high is important. This low is just internal structure and it needs more experience and knowledge to use. So we wait for our main structure to get broken. You can see that if you try to take trades in these conditions, because our primary leg is this big leg and we are in the middle of that leg, you may not end up trading well and end up in profits, because it is going to have a lot of unreasonable volatility in the market. Anyway, we wait until the low or the high gets broken. You can see that it breaks here. It is our main leg, so we wait until it comes down, retraces, and we use Fibonacci and our trading setup to enter the market if that happens. It retraces. You can see that our primary leg is here, but we have two primary legs because this pullback is very small. So we have two primary leg, and we use our Fibonacci tool that I'm going to teach you in this video, and our entry setup to enter the market for only buys. You can see that it comes up, it breaks the structure again, it breaks the high again. So we are going to use this leg as our primary leg to enter buying trades when it pulls back, to catch the higher low. It is our leg. You can see that it came down, it pullbacks, and it goes up again. We have another break-off structure. We are only using these structures to catch buying trades before this break-off structure and this break-off structure happens. But let me see the higher time frame. This primary leg is intact, so we use our Fibonacci for this long leg first, and then in lower time frames we can use this leg as well. I mean, you can take, for example, medium term trades from this large leg and short term trades from this leg. Let's see what happens. It broke the low, it comes up, it retraces, and it is going up. Why? Because this high broke this low. We are going to mark this high. Excuse me, I didn't pay attention too well. So we use this leg for short-term trades and we use this leg for longer-term trades. But anyway, our concept worked because I said that we use this leg as well, this large leg as well for our long-term trade from here, and we use these break-off structures as our short-term trades. For example, we can catch this higher low, it breaks the high, it pullbacks. We can catch this higher low and it breaks the high again, and we wait until it pullbacks. You can see that it works well, and that's enough for a structure and break-off structure. Let's summarize it up. So when we have our primary structure from, for example, from this point to this point, this high is our primary structure and this low is our primary structure low. So we wait until the low or the high gets broken. For example, it pullbacks and it breaks the high, then it is our primary leg. We wait until it pullbacks and it retraces, and then we try to catch this low using our Fibonacci tools and our order block liquidity imbalance concept for POIs, plus our entry setup using divergences plus shifts. Let's talk about Fibonacci tool. There are a lot of support resistances and order blocks and imbalances on the chart, and Fibonacci's help us to filter the best zone out because we want to take the highest probability trades. So we use the break-off structure concept to see how the market is behaving and in which direction we should invest. So after a break-off structure, we pull our thing, I mean our Fibonacci out, and mark this 50 to 78 levels to filter out our POIs. First, what is the most important POI? The most important POI is a POI that has imbalance. That can be an order block, that can be a liquidity point, that the imbalance is lower or higher than that liquidity point. Our support and resistances which broke with an imbalance. So the imbalance is our first indicator for a good POI. But we have a lot of imbalances. We have a lot of order blocks and we have a lot of POIs like support and resistances, volume POIs, and any kind of other POIs. So how we filter them out? We use our Fibonacci tool. So let's talk about Fibonacci's on charts. So how we are going to use our Fibonacci tools plus market structure to filter out our best POIs to enter the market. Firstly, we should identify our structure and order flow. Here is our structure that got broken. So our order flow is to the upside and we just should take buying setups. Now, how to identify the best POI? For example, we have a point of liquidity here. We have an order block right here, and we have an imbalance and order block right here. So these POIs can provide us with a shift and a good trade. But how to identify which places is best to enter the market? We use our Fibonacci tool from this low to this high, and we filter out 50% to 78% of it. When the market is going up, we should use our Fibonacci tool from the low. I mean, we pull our Fibonacci from the low. The low should show the one number. How to add these levels? You can see my levels here. You can just double click on a line here and this will open. You can add your levels like me and click the OK. So when the market is going up, we are going to pull the Fibonacci from the low to the high. And for example, here if the market is going down, we are going to pull our Fibonacci from this high to this low. I mean the one number should show the high, because we want to use our Fibonacci to filter out the amount of retracement that is enough for a leg, and that's 50% to 78% of that leg. Now we have our Fibonacci from this zone, that is 50% of the leg, to this zone. So you can see that this order block has been filtered out. You can use support and resistances as well. For example, we have a support and resistance here, and we have another one here. You can use any POI identification method, and even with only using market structure, Fibonacci levels, and that setup that I'm going to talk about at the end of the video, you can make profit from this strategy. But for the best results, you should pay attention to POIs like order block, support and resistances, and other things. So now we have our Fibonacci level. Our Fibonacci level is from here to here, from 50% to 78%. And we can see that the market comes down and it starts to rally from here. Now we should wait until another structure point gets broken. We can see that the high is getting broken, so we have this level and our Fibonacci is from here to here. Another important thing is that we have this big leg as well, so we pull out our Fibonacci from here to here and from here to here. Because that leg is too big, 38 level is a good POI and level as well. So somewhere in the middle of this box it can reverse as well. But if you only want to take the rates from 4 hours and 15 minutes, 15 minutes is going to be our entry time frame, you can just use 4 hour structure and don't pay attention to higher time frames. So the first thing that I'm seeing here is our Fibonacci levels from here to here. We have for example, we have a liquidity point here, liquidity point here, an order block here, and you can see how the market reacts. It came down, it grabbed this liquidity. Our trading setup, our entry setup will filter out most of these failed movements that, for example, we level our Fibonacci's and we mark our zones, and it just doesn't react in the way that we want to trade, and we don't take a trade there. But anyway, let's see which point gets broken. The high is getting broken, and we have this level as well. And another important thing is this low is getting broken, so we can use, yes, we can use this level as well, and our zone is going to be here and here as well, right? So we could take entries here that I'm going to talk about, and it is a very good trade. It is going to go up, I think, and this will not work out, I don't know, but I think that's the more probable to take these buys. But if you want to be a trader, we are not analysts, we don't make money from signals and from analyzing the market or markups. We take profits from trading with high probability setups in high probability zones in high probability directions. So if you can take this buy, you should pay attention to this zone as well, and if it provides you with a selling opportunity, you are going to sell that as well. But you are going to manage your trades, for example, from a 4-to-1 reward risk ratio, and after that. Now, let's see what happens. You can see that our buying zone may fail, but this will cover that because it is a 4-to-1 reward to risk ratio. It is more than 4-to-1 reward to risk ratio, and it is just a stop loss. The other trade that we could take is this 78 trade. So we can take that as well if it provides us with a setup in lower time frames that we are going to talk about. So now we wait. You can see that the low gets broken. We pull our Fibonacci from here to here. It's 50 to 78. And you can see the results. Our low gets broken again. But I think it will reverse from this point because it's a lot of liquidity. But anyway, we are just paying attention to our concept. It starts to pull back. We pull our Fibonacci from this high to this low. And 50 to 78 level, you can see the results. And after that, it breaks the low again. So we pull our Fibonacci from here to here if it pullbacks. If it doesn't, we update our Fibonacci from this low to this low. And another thing that it is important, our 50 level to 78 is here to here. But the other thing that you should pay attention to is that it broke this structure as well. So we have our Fibonacci from here to here and from this low. So our 50 to 78 can work as our buying opportunity. It didn't work out, but the buys that we draw here, it worked out well. It broke the low again. You will see at the end of the video that we filter out all these stop losses or all these failed POIs with our buying and selling setup that I'm going to teach you for free. So don't worry if, for example, this buy doesn't work out well, but this sell is going to cover its stop loss and you will end up with a lot of profits. So this is our leg, and this was our leg as well. I didn't pay attention to it, didn't hit our 50%. This leg is going out of the charts. Whoa, that's a big movement. You can see that we identified this trade and it can cover our year. So an important box is from here to here. And another thing that I didn't pay attention to is that it is breaking a structure to the upside. We can wait until it happens. Here it broke a structure to the downside. It is our Fibonacci from here to here. And another thing is that this leg, I think it is over. This too extended for leg, but we are following our mechanical strategy anyway. You can see the results from this point, and we wait until the next structure gets broken, and it is this structure. So we pull our Fibonacci from here to here. I think it is better to pull it from here. And 50 to 78. Let's see what happens. It is going up. I said that this downtrend is going to need a retracement. Anyway, this is our leg now, and if we have pulled out our Fibonacci, we could take this trade. I didn't pay attention to it, but it is from this strategy that I'm talking about. Anyway, let's see what happens next. It breaks this high, so, and it hit our box here, so any selling trades from that point is valid, and any buying trade from this leg is going to be valid too, from this point to this point. And this is our next box. Let's see what happens. It went up from this point, and it will be filtered out with our trading setup that I'm going to talk about. Don't worry about it. And our selling setup worked as well. So you can catch all the movements, you can catch the selling setups, you can catch the buying setups with this strategy, but we need another part of the puzzle, and that is going to be our entry setup. Let's talk about that on charts. That doesn't need any explanation other than charts. Let's get right to it. First, let's add our tools. First is going to be VMC, Woman Chu, Cipher B plus divergences. Add this one, and we need another tool, a stochastic RSI. No 10 is good because it has divergences in it. And what are we looking for? First, you can go here, double click on VMC Market Cipher, and go and remove things that we don't want. For example, I don't want stochastic RSI, I have that here. Regular divergences and other things, it's good. Let it be in this way. I change this a little bit. You can change them or you can keep them. I found that these settings work better. I think 21 is going to be better. So we use these two tools, VMC Cipher B plus divergences and Stoch RSI plus divergences. We use these two tools for finding divergences. What is a divergence? It's when the market is creating a lower low and the indicator is creating a higher low. So it is a kind of divergence that you can put a line here and here. Or the market is creating higher high and the indicator is creating lower high. These are the things that we are looking for. You can use other kinds of divergences. For example, when the market is creating higher low and the divergence is creating lower high, that's a continuation divergence, I think, and vice versa for highs. So these lower shapes are indicators and the higher shape is the market. You can take a picture from this right now. I'm going to wait some seconds. Let's get to it. So it's that simple. Don't mix things up for yourself. We are just going to use these kinds of divergences in lower time frames, for example 5 minute or 15 minute, in a 4-hour POI that we mark with our Fibonacci tools plus market structure. Now let's start here and forward test this strategy. Now let's see how we can use these concepts. Our break-off structure happened here, so we are looking for buying setups. We pull our Fibonacci from here to where the market starts to pull back. I don't know where it is. Now we have our box from here to here, and we wait until the market pullbacks to that. It didn't pull back. Now it broke the high right here. We can add our Fibonacci from here to here, and it is our box. Let's get back a little bit for teaching purposes. Anyway, we are going to use 5-minute time frame for our trading setup. What is our trading setup? It is shift plus divergences. What is a shift? We talked about divergences. A shift is when the market is going up, it breaks the high first, and it comes down and breaks the low. It is a shift that we talked about this concept a lot in Ultimate Smart Money trading video, in recaps, in ultimate liquidity videos. We talked about this concept a lot, and it should have an imbalance itself in the middle of this leg or anywhere that we can find an imbalance. What is an imbalance? It's the space between the shadow of the first candle and the shadow of the third candle in a 3-candle formation. It's an unfilled gap. For example, in charts, we have a big imbalance here from these shadows to this shadow. Why? Because this shadow didn't touch this shadow. It is an imbalance. We talked about this too. Anyway, so we are going to look for divergences plus shifts plus imbalances in the POIs that we use market structure and Fibonacci for. We can see that the market made a new lower low, but the indicators are showing higher lows from this to this and from this to this. And in this part of price action, you can see, it is better now. You can see that the market is going down, and the stochastic and RSI is showing higher lows. You can see that this low is higher than this low. And do we have a shift? Yes, it is our shift from here. This shadow, you can see that shift. It shifted the market. Why? Because the market came down, it broke the low and creates another low, and it went up and broke this structure. Where is our imbalance? Our imbalance is right here. So we can enter here for a 4-to-1 reward to risk ratio. Sometimes it is a stop loss, sometimes it is a profitable trade. Let's see what happens. It is a profitable trade. Now we go to higher time frames and we wait until the next structural point gets broken. It is our primary structure, so the high or the low should get broken first. The high gets broken, excuse me. My internet connection is a little bit slow. We are in an internet blackout. We are the second worst country in internet speed. Anyway, here is the low, here is the high. It broke this high. So where is our box? It's from this 15% to this 78%. What we do now, we have our box, we identified our POI, we are going to go to lower time frames, for example 5-minute time frames. Do we have a divergence right here? We had a divergence here, but this shift wasn't a good shift because we have a POI here, and that is a good POI. Anyway, you could take a stop loss here. That is going to be okay. We don't care about the stop losses because a good profitable trader is a good loser first. It's better for both indicators to show divergences. This stochastic RSI is showing a divergence here to here, but this one isn't showing any kind of divergence, so we wait to see what happens. Do we have a divergence here? No. We can take continuous divergences. I mean, the price comes down, or these indicators, for example, it comes and it makes a new low. It is a kind of divergence. The indicator showing a lower low, but it is going to have a higher low. That is a good continuation setup. Let's see what happens. I don't think it will happen. Let's see. Anyway, our concepts work well, and that is important for us. Oh, we had a divergence. I'm sorry, I didn't see that here. I was paying attention to macro structures, and this minor structure showed us a shift. You can see that sometimes the market is so subtle and you should pay attention to smaller details. For example, here it is a lower low, but these two indicators are showing us higher low, and this is showing us a higher low as well. I can FU trading view. This shows us a higher low as well, and here is our shift because it went up and it broke the structure. So where is our entry? It is going to be on the first imbalance or the second imbalance. The imbalance is the place between the first and third candle. That is pure body. We have an imbalance here and we have an imbalance here. Either of them are entry points, and our stop loss is going to be this low, and it provides us with a 4-to-1 reward risk ratio again. Let's see what happens. Now we go to higher time frame again. We wait until this high or this low gets broken. Let's see what happens. The high gets broken. I'm sorry, I can't control it. It will bounce. But we are using mechanical strategy and we have all the details we want, so you can test it and you can see that, for example, on DXY, for example, on stocks like Apple, Google, or other indexes, it works well. Here is our box. Let's remove this. Now we go to 5-minute time frame and see what happens here. Do we have a divergence? Yes, we have a lower low here, we have a higher low here, and we have a higher low here as well. Do we have a shift? The shift is important. Why the shift is important? Let me explain to you. Why we don't use just divergences? Imagine the market is going down. It is right here. And the indicator is in this shape. And it is here. I'm no scammer. I don't want to sell you courses. I have a lot of students right now. You can join my mentorship, but I don't care really, because I have the money I want. Really, I have the money I want. I need your support. Your support is much appreciated because our internet connection is very slow and it's dying out. I may have to buy Starlinks. They are smuggling Starlinks to the Iran. It's so complicated right now, but I have more than 200 students right now, and I don't advertise for students. So I'm going to teach these things free for you. I don't want to scam things up. But other gurus, what do they say? Oh, we have, for example, divergence here and it works. No, it doesn't work like that. If you try to just use divergences that you learn from other gurus, they say that the market is going down and the indicator is showing higher low. Why? Because most of the time when the market is going up and it reverses, we have a divergence here. Or when it comes down and it reverses, we have a divergence here. And they think that the divergence is the important part here. But they don't know how divergences work. For example, it is here. The gurus talk about the divergences that you can enter the market, for example, here on the next bullish candle. What happens? It is the next bullish candle right here. Let me draw that for you. For example, we have a bullish candle here, and they can enter the market right here. How does oscillators work? When the market, for example, make another movement to here, this oscillator is going to go lower than this low. If it prints one or two downside candle, it is going to print a new low, and it's not a divergence anymore. So these details are important. Pay attention to them. I don't want to sell dreams to you. These strategies are tested and you can go and test it yourself. It works or it will not work. That decision is up to you. These are not financial advices and you should test them, and it's your responsibility. At least you should practice them. You should test them to know how do they work. But pay attention, please, for the love of the God. Pay attention to the details that I'm talking about. So the market should shift after the divergence, because I know that some of you are going to test it, for example, just with divergences, and it will not work well. Anyway, we have a divergence here where the market did shift. It shifted here. Where we are going to put our entry, we are going to put our entry on the imbalance. It is here. It is not something that I'm making up right now. I talked about these rules before these things happen, and you can see that it is going to upward. I don't know it is going to provide us a 4 or not. I think the 3 is guaranteed, but the 4 I don't know. Let's see what happens. I think it is a stop loss. Yes, it is a stop loss. Wait, don't go. So we have a stop loss here. Don't worry, we are going to count all the trades at the end of the video, and to be a good trader you should be a good loser first, because you are going to have a lot of losing trades, but your profits are bigger than your stop losses. So we should wait until this shift happens. Do we have a divergence here in this indicator? Yes, we have. In this indicator we don't have a divergence yet. So let's see what happens. It shifted here. We should enter the market on the first imbalance, and that is going to be here to this stop loss. Does it provide us with a 4 or not? I think it do. Yes. So it was a more legit trade because it was like live market conditions, and it is stressful for me too. We should wait until the high gets broken with a body, or the low gets broken with a body, this high or this low. Let's see what happens. The high gets broken, but with these two candles I don't risk my money. You can see that the momentum is too high. I don't know what happens next. I think the low gets broken anyway. Now we can, it's better to do nothing, honestly, because it didn't break the low with a body, but we can risk a little bit of our money in this down movement. We are going to pull our Fibonacci from here to here because it did break this low with this shadow. 50% to 78. 5-minute entry. Do we have a divergence? Let's see what happens after this. Oh, it did start to pull back from here. So let me see if we had a divergence here. It is going to upward, it is going up. No divergence here, no divergence here. No, this one didn't provide us a divergence, but it did provide us a shift. So we could enter, for example, on these highs. I talked about line shadows. Line shadows have imbalances in themselves inherently, like here. I talked about this in the channel. I don't know which video, but the people who follow me know that I talked about these line shadows. The line shadows have imbalance in them inherently, and we didn't have a good shift as well. So let's talk about the next day. It broke the structure here. It is a minor structure, but it can provide us with a good trade. Let's see, where does the market starts to pull back. It is our first leg and it is our prior leg. I don't know the exact pronunciation, and it is a big box, but I think it is going to work. Let's see what happens. Another important thing, I think, I don't know really. Let's see what happens. It broke the low again. So we have another leg, and that is going to be from here to here, and our main legs is going to be here to here. So this box is going to be from this 50%. You can see that, but I can't see. It is our latest leg, I mean this leg's box, and it is going to be our next box. Let's see what happens. So it didn't let me talk about an important concept here. It is so important. You may think, oh, it didn't happen. No, you are a trader, you are not an analyst. So what happened here is that you may say that, oh, it broke the high, we got taken out of the market, we had a stop loss. No, we don't have a stop loss. We should go to 5-minute time frame and find our entry points. So from this to this point, we don't have any entry points. We don't have any entry setups. Where are you going to put your stop loss and risk your money in these conditions? You don't have a shift. The first shift happened here in 78% of that leg that I talked about before. It where you can see that it is our 78% of this bigger leg. So it is our entry point, but in which place? When the shift happens, it is our 78%. Did we have a shift here? Yes, but this is not a good shift, but let's say that we take a stop loss here. It came up. Where did it shift? It shifted here. I'm going to risk my money in this zone, and I'm going to have a stop loss here. But the most important thing, I'm going to make these red boxes for a stop loss, making them bigger so we can count them at the end of the video. But our entry point is going to be this imbalance here for this stop loss, and it is a 4-to-1 reward to risk ratio. You can see that here, right here. So the more important concept here is that we had two stop losses here. So what? We have a 4-to-1 reward to risk ratio after that. It's not like wonder world. It's not a dream world. It is the real fight between you and with other traders, other masters that are in this industry for 10 years, for 20 years, for 30 years, and you want to steal their money. You think they act like characters of the Oz City? No, they are beasts there, and they are waiting to take out your money. So two stop losses, if you get crazy with two stop losses and you are going to blow your money with over trading after two stop losses, you are not ready to come to this world. I don't talk like other gurus that show you a 40-to-1 reward to risk ratio to sell you courses. I'm here to face you with real conditions of the financial markets. And the most important thing here is patience. Let's see the other opportunities. So, if I was trading with liquidity and smart money concepts, I would take trades here, but we are going to talk about our simple strategy. And we have a break of structure here. The pullback started from here. If it starts from here, so we have our buys from this point to this point. It went oh, wait. Let me see, is it 50% of this leg or no, because it can be a legit trade with our strategy. Yes, it is 50%. Let's go back. I couldn't find the stop button. Here is our break of structure, and the other thing is that we pull our Fibonacci from here to here, and from 50 to 78 is our box. We go to 5 minutes and we try to find our divergences. We don't have a divergence here, but with these two indicators, they are showing a minor kind of divergence from the candle's low. You can see that from this low to this low, from this point to this point, and from this indicator didn't show us a divergence, but anyway, this indicator did show us a divergence, VMC. So we can risk here, but I think I wait for the next divergence. Where did it happen? It happened from here to here. It is a continuous divergence, and it happened from here to here. It's a regular divergence. But where are we going to enter the market? Right here. I really talked about this entry before this leg moved up. I'm sorry, I can't pause in the right time because of the lack of time. Anyway, why we enter here? We didn't find any imbalances here that the market would, for example, come down and goes up. So we take another imbalance as our POI. Where is it? It is right here. We put our stop loss under this opening and closes. You can see that here, or under the candle that made the imbalance. It is important too. Why it is important? Because it is a support and resistance in lower time frame. The market went up, went down, and continued. It's moved upward, and then it came down. it touches our support and resistance and it goes up. So our important thing is that we can put our stop loss under the candle that made the imbalance or under these opening and closes right here. And in either way, you are going to have a 4-to-1 reward to risk ratio. Anyway, it was a profitable trade, so we have a green box here. 4 hour. We wait until the high or the low gets broken. Okay. The high gets broken. Our leg is from here to here, so we pull our Fibonacci from here to here. And we wait until it comes down to 50% to 78%, and we go to lower time frames and we find our divergences. So if you didn't find, for example, where was my, we have another leg here. You can pay attention to these concepts as well, but if you can manage your focus and you can focus on all the legs, you can do anything you want with this strategy. It is a good strategy, but the most important thing that I forgot to talk about, I wanted to talk about, is that I pay attention to the last break of structure, this break of structure, or this break of structure, or this break of structure. Don't pay attention, for example, don't go and find this structure that broke. It is for higher time frames, or this structure that broke. You should zoom in and see what happens right now. You can see that it breaks the structure here. So our leg is here, not that large leg. That isn't our battlefield. That is higher traders battlefield, higher time frame traders battlefield. You should identify your battlefield. You should describe your battlefield and describe your time frames. For example, I use 4 hours and 15 minutes for this strategy and 5 minutes for this strategy. What do you use? Which time frame you are comfortable with? You should find that yourself. So let's summarize things up here. Let me close these two indicators and just talk about the meat. So here our structure broke to the upside. We wait until it starts to pull back. We use our Fibonacci tool to mark our box from 50% to 78%. I'm sorry. Then in this box, what we do in this box, if we zoom in this box in lower time frames, for example, we have this box here. What we should have here, we should see until it comes and goes to this box. So when it touches this box and, for example, we have a lower low here, our indicators should show higher low. When the shift happens, what is a shift? When the market breaks the high that broke the low and we have an imbalance, you can enter the market on that imbalance, put your stop loss below the low or the candle that made the imbalance. And always manage your positions in 3-to-1 reward to risk ratio, 4-to-1 reward to risk ratio, or 5-to-1 reward risk ratio. They are important numbers. Don't get greedy. I forward tested it for you for 10 trades. We had 5 profitable trades and 5 stop losses. Because we use 4-to-1 reward to risk ratio to exit our trades, that can be 20% from profitable trades, because 5 multiply 4 reward to risk ratio is going to be 20% of balance if we risk 1% of our balance on every trade. And we had 5 stop losses, so we have 20% in profit and 5 stop losses, 5% for our losses. It counts to 15%. in less than a month. You can go and test this yourself with the details I provided you with in this video. But remember that every strategy has its winning streaks and its losing streaks. For example, in this video I took 4 stop losses in a row, but I had 5 stop losses and 5 profits. So if you take 1 stop loss or 2 stop losses, don't freak out. The profits is going to come around sometimes. And because we take 4 reward to 1 risk, I mean 4 reward to risk ratio, we for example risk $1 for $4, we are going to end up in so much profits after using this strategy repeatedly day after day. So we mark our structure and Fibonacci levels in 5-hour time frames, and we take our entry setups in 5-minute time frame. Your support is much appreciated. We are in an internet blackout here. I'm going to provide you with a lot of free contents in this channel, so you don't need to enroll in my private mentorship on other teachers' private mentorships. But if you like to reduce the time that you can enter the markets for a demo account or for a real account, and you want to have a mentor that supports you on a weekly basis with one-on-one webinars, I'm here. So you can contact me in Telegram channel. It's a 6 months private mentorship that we are going to have 1v1 webinars every week, and you can see the depth and the extent of our knowledge in this channel right now. It's for the people who want to reduce their student time and want to enter the market as a professional sooner. But for patient people or for people who don't have enough money to enroll in mentorships, you can watch the videos in this channel for free, and I assure you, you learn a lot more than most expensive mentorships for free in this channel. Thank you for your watching. Your support is much appreciated, and see you around.